as we stand, the company has probably one of the best grades in the world. I think it's top 3 on grade, 17 grams per ton, and a very low cost of production, which is $540 an ounce.
Essentially, there are 2 projects that you've got. One which is
Segovia.
Now that's the one with the high grades at the
Correct.
moment, and obviously producing somewhere in the region of 193,000 ounces. So that's a significant producer. You've also got Marmato.
Correct.
So tell me about that. That's a bit earlier in the process.
Segovia is very much developed. We operate 3 of 23 mines in a concession that is truly a private property in Colombia. A rarity. We own the mineral rights and the land, so we don't pay any royalties. Much more mature than Marmato. As you said, we produce over 190,000 ounces at a very low cost. Marmato is our next project. Marmato is a project that started actually before Segovia. Unfortunately, with the prices of gold going down, the project became very expensive to build. It was over $1 billion. So we changed the design of the mine by going underground and by developing the underground part. Today, we have a project that is in the development stage. We produced 30,000 ounces there. Now we're going to go into an expansion phase. The expansion phase is going to be to take the production to 180,000 ounces.
Explain how you've gone about your thinking. Why have you structured things this way?
Well, we went through the good times of when mining and it was very easy to raise money. There were a lot of funds in the world and everything. In the last 6 years, it's become very challenging, very difficult to develop projects. Through ourselves, our management team, Mike Davis especially, that is fantastic on the financial side, we had to reinvent ourselves in ways of creating liquidity in the company to build the projects, but at the same time maintain the structure of the company of not getting super diluted.
Right, and that's tough because a lot of people are just happy to survive when it gets tough. You've actually been able to build this out and get into production, significant production. You're a mid-tier producer now.
Absolutely, and on our way to become a large producer because with the Marmato development, which is our latest financing that we're going to be doing, we are going to go to 400,000 ounces. We've been growing for the last 4 years, every quarter, 15 to 20%.
That's PE type returns.
Exactly.
That's great. Okay.
So the company has taken the cost of production when we started taking the mine over of $1,100 an ounce. We're down to $540. How do we do it? We started looking at the possibilities of doing things. These days, when you go into streaming, the streaming is a very expensive way to finance yourself. It's dilutive to the investors. It's very punitive to the investors. And our group, my partner, myself, are probably the largest shareholders in this company. We are very much aligned with the rest of the shareholders. So for us, it's important that we don't do steps that prejudice the investors. Instead of giving the money to a bank or giving the money to a streaming, we give it to our investors because most of our shareholders are the guys that own the bonds.
So what are the terms on that?
The terms of the bond of the bond that we have, the only bond that we have, it's an 8.5% coupon.
Nice.
We cover the downside, which is $1,250 gold. So we guarantee that you will get $1,250 gold.
Okay.
You get all the upside on the amount of money that was lent to us.
Right.
So in the case of this case, when we started the bond was $100 million. We're down to $68 million in the first year. We already paid a very large.
So what's the term? When's this due to be paid?
The terms, it's going to be paid. The terms is 2024, but we're going to finish paying it in 2023.
Early redemption, no penalties.
No penalties. No, because it's at the end of 2023. But the paper is a fantastic paper because it gives you the coupon, steady coupon. It gets paid, interest get paid on a monthly basis, so it keeps a discipline. And the principal gets paid on a quarterly basis. Plus, on the quarterly basis, you get a kicker if it's above $1,250.
Wow.
So it's a paper that gives you 11% return.
Yeah.
Every month we set an amount of gold aside in Scotia Bank, and at the end of every 3 months we cash in the gold, we pay the principal. The bond was placed in the hands of large institutional investors. They're very happy. And with this kind of system now, we created a situation that we are going to be financing. The next step is to finance the Marmato mine, and the Marmato mine is going to be financed in the same category of bond.
Okay.
And the same shareholders and the same bondholders are very happy to participate into this thing again because they see that it's a very profitable and very secure.
It's definitely profitable. I guess the question is, do you need to do it that way? Can you go conventional? What are you going to do with the money to develop?
Well, the money of Marmato is going to go for developing literally the expansion of the mine. We're going to take the mine from 30 to 180,000 ounces. So it's a construction of a plant. We're going to be mining the upper portion of Marmato conventional, and we're going to go underground in a sub-level stoping type, very large, 4.5 gram material. We have 3 projects in the pipeline as a company that we have to grow. Once we have Marmato going, we have to think what's next. One of the projects is very well advanced, but it's in the hands of a major. It's IAMGOLD has the Sacudo project.
Okay.
They have 2 more years of exploration. They're spending $10 million right now in drilling. It's a beautiful project, very much like Segovia, high-grade gold, lots of silver, probably more silver than gold, but about 15, 16 grams per ton.
You've very few shares out, very tightly held.
Correct.
Yeah, so management is, how much does management go on?
Management is somewhere around 19 to 20%. Depends if you look at the warrants also. 22 probably with the warrants.
Okay, fully diluted, right, okay.
Yeah. Outside of us, probably another 50% in institution and the rest retail.
Okay, so meaningful retail. Because the retail component is obviously what kind of tends to move these things in terms of the liquidity.
We had 21 million shares about a year and a half ago.
Okay, but you...
we issued, what we did, we got rid of some of the debt of a silver note, and we converted it, most of it, a lot of it was our management and the same institutional investors. We felt that at the time with stock at $2.20, it was a good idea to convert and create some liquidity in the stock because it has zero liquidity. Unfortunately, it backfired on us. Everybody converted. The stock went to 350 and then went to 450, and it's now in the 360 range.
Yeah.
And nobody wants to sell.
So you've got physical gold secured.
Correct.
You've got cash. So you've got lots of options.
We got lots of options. The other thing is we only use to repay, we own $69 million as of last month.
Right.
By July, we're going to be down to almost 59, I believe, that it's going to be.
Right.
The $59 million that it's owned only represents 7% of our production a year to repay that.
So less than the 10 in here, right?
So
okay,
it's insignificant.
Yeah.
So we rather go to the process of repaying that debt. The new bond that we're planning to do is going to be done strictly not on the corporate level, it's going to be done on the project level.
Your EBITDA from 2015 to today is, literally that's a nice chart.
It's a fantastic little chart.
Yeah.
We're very happy with it.
Right.
What we're not happy is with the price of the stock.
Just don't tell me you're undervalued. Because
No,
everyone tells me
everybody
that.
says that.
But tell me, okay, you've had this kind of very fast, rapid ascension to where you are today on the EBITDA. What's next? What builds it up? I know you've got to develop a second asset, but is there more M&A planned, or is it a case of focus on these other exploration assets that you've got? How do you keep that projection?
Yeah, well, obviously the Marmato project is going to be significant because we just doubled our production. We already started the path of the M&A. We're looking at new areas in Colombia. There is the.
So you're comfortable in Colombia.
We're
You know
very
Colombia.
comfortable.
And
Colombia's
you're able to
our home.
find good assets. You're able to assess good assets.
Oh, there's still very big amount of assets to be discovered there. But as part of our plan, obviously the next step is we already started with Sand Spring by taking a 19% position in Sand Spring. We believe it's a good jurisdiction.
There's a non-operational position, right?
It's non-operational, but we are giving some directions to management on how to proceed to build it through the experience of our management team.
In terms of your production, you're saying you're going to get potentially to go from 225 up to 400 a year by the end of
2023.
2023. Okay, so that's with the kind of AISC which you're looking at, that should be generating a lot of cash. So what's the end game here? Is this just a cash cow? We're going to keep running it? Or do we sell it?
At that point, that's when the decision's got to come in. One decision that we made is we were looking at one point for strategic investors, strategic partners to grow. People came to look at us to see because they were very intrigued with our growth and everything. Our decision now is instead of being acquired, I mean, if somebody comes, we're a publicly held company. Somebody gives us the right offer that it's good for our investors. We're there to see it, and if it makes sense.
Yeah.
We're not here because we need a job. We're here because we want to make money. So if that happens, but right now the strategy that we've taken in the next few years, it's going to be growth and eventually acquisition of other properties, and we are very much considering at one point when we feel comfortable in the next few years a dividend payment, because this is going to be
Correct.
putting a lot of money out.